And now, Lifestyles Unlimited presents the Real Estate Investor Radio Show. Over the next hour, we unfold your map to financial freedom. You'll learn how to retire through investing in single-family and multifamily real estate. You'll learn how to create cash flow and build wealth so you can have the time and money to live the lifestyle you want.
Welcome to the Lifestyles Unlimited Real Estate Investor Radio Show. My name is Al Gordon, and as always, we're working on your financial freedom. And we're going to do so today by living vicariously through me. You want to do that? You want to live a little vicariously through me? Well, it's not too dangerous. I mean, I'm not in the Army anymore, so it's like things aren't blowing up around me. People aren't trying to shoot at me, none of that stuff. But what I am doing is I'm engaged in the combat skill of, well, negotiation. Yeah, I'm in the combat skill of negotiation. And you get to live vicariously through me. What does all this have to do with you, right? Well, it has a lot to do with you, because what I'm going to do is I'm going to give you an insight to a deal that I've been working on for about the last month. Now, this is a multifamily apartment community that I've been trying to buy. And one of the things that we've been working on is we're working with a seller that, as we have found out through all of our discovery, probably paid more for the property than they should have when they bought the property. And the challenge that they're having is that they're looking at the negotiation from how much money do we need in order to break even or maybe make a profit? How much do we have to sell the asset for in order for that to occur? Now, that's all fine and dandy for the seller side of the equation. For my side of the equation, I have to look at it through a completely different lens. I do. I have to look at it from the lens of, what can I afford to pay for the property without overpaying for it so that the property will produce cash flow, allow me to generate appreciation, allow me to force appreciation on the property, allow me to do the things that I know how to do with multifamily assets that will make it a great investment for not only me, but for my investors. And that's where the whole combat sport comes into play. It does. Because you've got one side fighting for what they're trying to accomplish. Then you have another side doing the same thing. And somewhere in the middle, hopefully these two entities are going to link up. Now, I told you, I've been working on this deal for the last month. My real estate agent, Cindy, brought me this deal. And initially I thought, well, seems to be a little bit overpriced for what it is. But let's not say no to the property, because it's at least in the target market that I've identified. So it could work out for what we're trying to accomplish. So we asked the seller for financial information. We asked for a T12. Now, if you don't know what a T12 is, it's basically the seller's financial reports for the last 12 months. It's something that we need to look at to understand the financial worthiness of the asset, to see what the asset has been producing over the last 12 months, so that we can determine whether or not we can continue along that glide path, whether we can make improvements, or whether we think there's going to be a degradation that could occur based on market influences that may not work for us. Does that make sense? I know I'm hitting you with a lot. And on top of that T12, we asked for something called a rent roll, because we want to know how they're doing with the health of their renters. We want to know, do they have renters on leases in their units, and which units are down either for maintenance, or which units are down due to a vacancy, or maybe both. And what we do is we look at that information, and we use that information to kind of lay a game plan for what we think the property can do for us. Now, when you become a Lifestyles Unlimited member, we're going to teach you this stuff. So everything I've been filling your head with for for the past, 4 minutes, it gets better. It gets better because if you're a Lifestyles Unlimited member and you've heard me talking about this asset so far, you're ready for the data. You're ready for the data. You want to, in your mind, you want to start plugging in the data that makes sense to you. Now, if you're not a Lifestyles Unlimited member, not a problem. Stick around because you're going to learn something. You're going to learn something about multifamily. You're going to learn something about the nature of how a potential transaction comes together, and you're just going to learn something you didn't know. So let me give the background on this property. This particular property is in the great state of Tennessee. That's where my target market happens to be. Now, I've localized that target market. What I'm looking for are properties in the greater Nashville area and in the Nashville MSA. That means properties that are in Nashville, Tennessee, properties that are around the perimeter of Nashville, Tennessee, and properties that are in the tertiary realm of Nashville, Tennessee. Kind of gives me a big net to throw. But I'm also looking at other parts of Tennessee because one of the things that I have learned is that with the type of investing I plan to do, with my ability to invest and manage, there are some opportunities outside of the Nashville MSA that might be of significant interest to me. So I'm not ruling those properties out. But my preference is to stay in the Nashville MSA. And here's one of the biggest reasons why I want to stay in the Nashville MSA. I live outside of the Nashville MSA. I want to be able to go to my property if I need to go there. I don't want to have to take a plane. I don't want a 6-hour car drive. I just want to be able to go to my property and deal with whatever I need to deal with. So that's one of the reasons that I really like that Nashville MSA, because I'm within like a 2-hour drive of my target market. So that's very important to me. Now, this particular deal is in the Nashville MSA, and effective just before I came on to do this radio show with you, I walked away from a deal that I've been working on for the last month. Now, some of you are going, "Oh, Al, that's too bad. That's so sad." But you know what? It's totally okay. And when we come back in the next segment, I'll explain why. Stick around. Welcome back to the show. So are you interested in finding out more about this property that I'm walking away from? Yeah, you heard me correctly. I am walking away from a property that I've been working on for the last month. It's a property that I wanted to buy. It's a property that met the majority of my purchasing requirements. It's a property that could work well for my portfolio, but there's a slight problem with the property. Now, that slight problem has nothing to do with the condition of the property. The condition, from what we can tell, is in pretty good shape. It's got nothing to do with the age of the property. As a matter of fact, the age of the property, it's split into two different age groups. One is a 1986 vintage. The rest of it is a 1994 vintage. So it's not too old. It's about 32 years of age in one realm. It's almost 40 years of age in another realm. It doesn't make the property too old. And that's important because there are life cycles of properties that exist that you and I have no control over. They're just what they are. So, in other words, a property that was built in the 1960s is what we consider a 1960s vintage property. It was built with certain types of construction materials, certain types of techniques. And what we have learned over time is that those properties require a certain amount of renovation, usually with the plumbing systems, sometimes with the electrical systems, because the plumbing systems and the electrical systems that were used at that time period, they don't marry up with what we use today. And they were prone to failure. They were prone to failure. Now, what does that mean? Does that mean you shouldn't buy those properties? No, that's not what it means. It means you have to understand what you're getting into when you buy a 1960s vintage property. A 1970s vintage property brings a different set of potential problems. Not the same problems that you get from the 1960s vintage, but a new set of problems that were created in the 1970s just for us living in the 2020s, right? Okay. 1980s vintage, same thing. 1990s vintage, same thing. 2000 vintage, same thing. The difference is, as we get closer to our current timeline in life, what we know is that the systems that have been put into these multifamily properties haven't really failed. They've lasted for quite a while. Now, that stuff from the 1960s, it lasted for quite a while too, until it didn't last. And it started breaking down. It started leaking. It started causing problems, which we know how to renovate as Lifestyles Unlimited members. There's just a price associated with doing that, and you have to calculate that price into your pro forma to determine whether or not you're going to make money with the asset that you buy. Now, let's go back to this property that I just walked away from. Here's the scary part. There was nothing wrong with it. From what I could tell, there was nothing wrong with it. Now, had we gotten past where we got to, which was literally trying to finalize the purchase price, and I'll tell you about how that went in just a moment. But had we gotten past that point, one of the things that I do as part of my due diligence, I scope the lines. I scope all the sewer lines. I don't care how old the property is. Stuff can break no matter how old it is. So that's one of the things that I do as part of my due diligence period to determine whether or not I want to move forward with the property. Or if I find that there's significant plumbing problems, I'm going to bring those problems to the seller's attention, because effectively whatever price that we agreed upon so that I could go into my due diligence period, that was based on the fact that the property was in good working order. But if I determine that something's not in good working order, it has to be addressed, which means either the seller may have to take responsibility for correcting it, or I've got to ask for a concession, a lower price, because it's not into the workup that I worked up to determine whether or not I make money with the property. Does that make sense? Now, I know a lot of you are about ready to change the radio dial. A lot of you are about ready to hit next podcast. Don't do that, because this is where the learning occurs. When I confront you with concepts that you don't understand, it can be, well, displeasing to you. You can feel like you just don't want to deal with it. But resist the temptation to walk away, unlike what I just did with this property. Stick around, because this is where the learning occurs. This is where the rubber meets the road. Dealing with stuff that you don't necessarily know anything about. Now, we can make this easy for you. You could just become a member of Lifestyles Unlimited. Lifestyles Unlimited could teach you succinctly how to do all this stuff that I'm talking about. And you could be like the Lifestyles Unlimited members that are listening to this radio show going, all right, Al, get into the meat of the deal. We understand all of this stuff. Get into the meat of the deal. Why didn't the deal work? Okay, let's get into the meat of why the deal didn't work. The seller was offering me this property at $3,025,000. That's what they thought the property was worth, based off of broker guidance, based off of whatever data they received. They felt the property was worth $3,025,000. However, once I received the T12 and the rent roll that I requested from the seller, and I looked through all the data and determined which was operational costs, which were CapEx costs, which were other costs, I was able to determine what the income streams were for the property. I could also determine what the expenses were for the property. And what I found was the expenses were pretty much in line with what I thought the expenses should be for this particular property. So I didn't have a problem there. Where I had a problem was the income stream. The income stream that was presented to me in the prospectus didn't match up with what the seller actually sent me. Yeah, they were two different stories. Now, the prospectus information that the broker sent, that matched up with like a $3,025,000 purchase price. But that's the problem. When I looked at the actual numbers that the seller has been receiving, actual income the seller has developed on this property, it doesn't support a $3 million purchase price. As a matter of fact, it supports more like a $2.6 million purchase price. Yeah, $2.6 million. So that puts us $400,000 apart on price. So one of the things that I was trying to do was I was trying to develop the data. I wasn't changing into the data. I was just developing the data to determine whether or not I could get to the seller's price point. And after talking with my mentors, after talking with my broker, we all determined $2.6 million was a more reasonable price for this property based off of the income that the property provides. And notice that I'm talking about the income that the property provides. Because on today's show, we're a multifamily. We're not doing the normal single-family stuff that I talk about. We're actually talking about multifamily assets, which may have thrown some of you for a loop. And when you're evaluating multifamily assets, what you're evaluating is the income potential. In the next segment, I'll give you the rest of the story. Stick around. Welcome back to the Lifestyles Unlimited Real Estate Investor Radio Show. My name is Al Gordon, and as always, we're working on your financial freedom. And we're doing so by telling you about a deal that just didn't work out for me. Yeah, it just didn't work out. I'm not upset. I'm not bitter. I don't feel like I've lost a month of my time. As a matter of fact, the effort that I put into analyzing this deal was very, very important. Because now that I've walked away from it, what I fully understand now is that the deal wasn't going to work. I would be chasing after a deal for the sake of buying a deal just so I could say, hey, I bought a deal. But that's not why we buy real estate. We buy real estate because it makes a difference in our portfolio. It provides us income streams. It provides us equity participation. It provides us tax advantages. If we're doing multifamily, it allows us to do something called forced appreciation. Very, very important stuff to understand. Important stuff that you can learn when you become a member of Lifestyles Unlimited, like I did back in 2017. And now I'm putting it all into practice. So earlier, I told you that the seller wanted $3,025,000 for this particular property. Remember that? Well, they still want $3,025,000. But based off of my analysis of the seller's financials, wasn't worth $3,025,000. It was really worth about $2.6 million. Now, the seller was willing to come down a little bit. And they indicated that to my broker, because I have a broker representing me. They have a broker representing them. Their broker indicated to my broker they would be willing to come down a little bit. And I said, okay. And I wrote a letter of intent for $2.6 million. I basically told them I'm willing to buy this asset for $2.6 million. So I sent in that letter of intent. In about 24 hours, I received a rejection. Sorry, we can't do $2.6 million. And I said, well, you do understand that I'm offering you $2.6 million based off of the income that the property provides. The actual income, not your prospective income, but the actual income. Because when I buy the property and I take it over, that's the income I'm stuck with until I can do something about it. So I have to operate based off of what the seller hands off to us, because unless a lease expires, I'm locked into those leases. And what I could tell, the seller was leasing the property up after doing some renovations on it, but they weren't getting the highest market rent available. I think they were just trying to get units leased up, so they were willing to take maybe $100 per unit less. Now, that would give me some potential to increase the rents. And that's one of the things that we look at as Lifestyles Unlimited members. Can I increase the rents? Now, on the surface, it kind of looked like, yeah, I should be able to go up about $100 per month based off the fact that the seller wasn't maximizing their rents based off of the market study they provided to me. So you know what I did? I did my own market study. And you know what I found out? The maximum that they're receiving on their current rents is equivalent to the maximum the market would bear. Yeah, so there is no $100 per month buffer that I can improve rents on without actually doing anything, just based off market forces, because it's not there. Doesn't exist. So that throws a wrench into the seller's marketing plan, because I've done my due diligence. I've determined what the true value of the property actually is. So I made the offer for 2.6. They came back and said, no, it's rejected. So I could have just walked away and said, okay, it ain't going to work. What am I going to do now? Well, what I did after it was rejected was I talked to my broker, I talked to my mentor, and I said, hey, team, let's regroup. Let's see if we can find a way to come up in price. I had my broker coordinate through the seller's broker to get some updated financials, because the financials that I received were only through the month of December. So when we received updated financials, we received financials through the month of February, which gave us some additional data to work with. And what we discovered was, with that additional income that the seller has, we could potentially go up a little bit in price. So we were messing around with what that number ought to be. Now, their broker communicated to my broker that we could probably get this deal done at about $2.8 million, maybe $2.85 million. So I sharpened my pencil and I went to work with the new data that the seller provided, talked to my mentor, talked to my broker. The three of us worked it through, and we figured out that 2.7 was my max number. That if I were to try and get to 2.8 or higher, it would be an inefficient deal, ineffective. It would not make the money that it needs to make. There are other deals out there that would provide better returns, so why would I be chasing this one? So we submitted another letter of intent for $2.7 million. And we got rejected. And the seller's broker said, you know, we really, really think we could get it done around 2.8. So I went up $100,000. They went up. They didn't go up. They went down. They went down what? 25, 50,000? All right, well, at least we got movement. And I said, well, let's go back to sharpening our pencils. Because I'm not willing to walk away from a deal based off of what's going on in negotiations. Because as long as they're negotiating with me, they're talking to me. That means they haven't walked away either. So I said, okay, what can we do to make the deal a little sweeter? What could we possibly do to make our offer of $2.7 million a little bit nicer? So we determined what we would do is we would reduce our due diligence time from 30 days to 21 days. And part of the reason we realized that we could do that is we've literally spent the last month analyzing this deal. We know really well what the financials are, what the potential will be. So we don't have to spend a bunch of time doing that in due diligence because we've already done it. So we figure we'll take a week off of that, and we'll try and get all this done by the end of the month. Well, I'm going to read to you what my broker sent me this morning just before I came out to do this radio show. Good morning. I just spoke with the broker, and the sellers cannot go any lower than 2.8. They've got 2.9 in it, plus an additional $100,000 in CapEx, and just don't want to lose any more than that. Okay. Well, that tells me they overpaid for the property when they bought it. They didn't quite know what they were doing. They're definitely not Lifestyles Unlimited members, or they wouldn't have done this. So I responded back and I said, well, I guess they need to keep it and continue to operate it. Still a stretch for me at $2.7 million. Going to 2.8 might solve their problem, but it creates problems for me that I may not be able to recover from. So I walked. And you know what my broker said to me? No problem. We'll just move on to the next. And that's what we're doing. In the next segment, I'll tell you my emotional distraught. Stick around. Welcome back to the show. So, you're wanting me to divulge all of my emotional distress that I've received by working on this potential deal. Now, I use the word potential because that's all it is. It's a potential deal. I don't have a deal with anybody. I don't have anything signed by anybody saying, hey, I want to move forward with you. All I've got is a negotiation, a little bit of paper that I wrote up that never got accepted. So I don't really have a deal that I could offer anybody. And I don't want to have a deal that I could offer anybody because this one didn't work out. It's as simple as that. Now some of you are going, dude, you're 100,000 apart. I mean, they've already come down a couple 100,000. If they said they would do for 2.8 and they were at a little over 3 million, and you said you would do it for 2.6 and you only came up 100,000, what's the problem with going to 2.8? Well, here's the problem. It doesn't produce the returns that it needs to produce at $2.8 million given the seller's income. It just doesn't work. It mostly works at around 2.7. Works really good at 2.6. And here's the part I didn't tell you. When I initially underwrote this property, I was like at $2.4 million. Yeah, 2.4. So when you look at where I was initially at compared to where I moved to, I've made a $300,000 move upwards. Granted, they've made a $200,000 move downwards. But at the end of the day, it doesn't matter who moves how much. What matters is that we meet in the middle, and we're not meeting in the middle. It's just not going to happen. This is literally the third time the seller has told me that they want 2.8 or better to do the deal. And I don't want to do the deal at 2.8 because it doesn't produce the cash flows that I need it to produce. It doesn't produce the return on investment if I were to sell the property, say, in 3 years or maybe 5 years. It just doesn't do it. Now, I know there are other assets out there. As a matter of fact, my broker just sent me one. Yeah, she's like, well, if this one doesn't work, how about this one? So after this radio show, guess what I'm going to do? I'm going to go back into due diligence. I'm going to go back into figuring out whether this other property she sent me can do for me what I needed to do. Now, granted, there's a seller involved with that property too. And I don't know what the seller's situation is. But here's what I know about the seller situation on the property that I just walked away from. They just bought it less than a year ago. They were trying to improve it. They're literally trying to flip it is what they're trying to do. And they're trying to get the maximum price that they can. And you know what? I'm okay with that. You do you. But I'm doing me. And I can't afford to pay the price that you want, even your discounted price. It doesn't work for my financials. Now, I have a key principal that I work with. And my key principal, I shot him an email saying, hey, deal pencils at 2.7, seller sticking at 2.8. I'm walking on to the next one. He said, you are, of course, wise to be disciplined. That's what my key principal told me. He said, you're wise to be disciplined. The right one will appear at the right time. Now, he's down in Dallas-Fort Worth. He says, DFW seems to continue softening a bit more. More lenders taking properties back and selling them. We live in interesting times. All the best, my friend. So, you think about it. I spent a month working on this deal. My key principal was behind me the whole time. My broker was behind me the whole time. My mentor was behind me the whole time. My family was behind me the whole time. And effectively this morning, I said, poof, it doesn't work. I am done. So I walked. And I told everybody on my team that I walked. And I think they're all happy. I think they all know that I dodged a potential bullet. And I know that I dodged a potential bullet because the financials don't work the way the financials need to work, not at the price that the seller needs. And my job as the buyer is not to fix the seller's problems. That's not my job. My job is to get the best deal that I can get for myself and those that might invest with me. And that's what I'm focused on. So it's on to the next one. Now, some of you might think, wow, dude, that's a lot of time and effort you put into it. Like a month? You've been working on it a month? Yeah, I've been working on it a month. But it's not like I've been spending 40 hours a week on this thing. I spent a half an hour here, 20 minutes there, maybe an hour going over my due diligence spreadsheet that I use to keep all the numbers in order. I don't put 40 hours a week into determining this stuff, but I do put in as much time as I need to, which really isn't that much time. So, if I really sit back and I think about the amount of time that I've consumed over the last month on this project, it's maybe been 4, possibly 5 hours total over a month. So what does that work out to be, like an hour and 15 minutes a week? Hour and 20 minutes? Okay, call it an hour and a half. It's not that much time. And what I've learned from this particular project is it's not going to work for my investing goals. So I'm just walking away. Now, did I tell the seller that I'm done, I'm completely out? No, I didn't tell them that. I'm effectively walking away and leaving them with my $2.7 million offer intact. Because here's what I also know. The seller received other offers before mine. 2 at $2.6 million, 1 at $2.65 million. And the seller rejected all 3 of those offers. And they let me know that when I started the negotiation process. It's part of the reason I started at 2.6. They came back and told me, well, we already got offers at 2.6 and we rejected them. Okay. It's part of the reason I got to 2.7. But I can't get past 2.7. But I want the seller to know that as time goes on and they don't receive any offers that are any better than mine, I might still be around to acquire this property. I didn't tell them no. I just told them no to 2.8. I just can't do 2.8. But I can do 2.7. These are the things you learn when you become a Lifestyles Unlimited member. You learn how to negotiate this stuff. You learn all the fundamentals about this stuff. This negotiating stuff is kind of like sport. And the better you are going into the game, the better your results. So I strongly think if you're going to do this real estate investing and you're going to stop doing what you're doing for investment, stop relying on gold, stop relying on precious metals, stop relying on the stock market, stop relying on everything that isn't real estate, and you start focusing on real estate, and you start realizing that real estate is actually better positioned than all of those other investment strategies to do for you what you're trying to accomplish. The one thing that you're missing is education. And that's where Lifestyles Unlimited comes in. We are uniquely positioned to provide you the education that you need, the tactical, the operational, the strategic thinking that you need in order to be successful at doing real estate investing. Now, you may say, well, Al, you weren't very successful with this one. And I would counter, I would say, yes, I was very successful at this one, because what I learned was that I wasn't going to buy something that wasn't going to work for my portfolio, which is just as important to protecting my portfolio as buying the right deal. Where did I learn all this stuff? Lifestyles Unlimited, an organization that's been around for 35 years, teaching people like you, people like me, how to do this stuff. It's all secondhand information to me at this point, because I know the information so very well. And you too can know the information very well. But what we've got to do is we've got to get you started. Now, the best way to get you started is to point you to a website, lifestylesunlimited.com. I'll say it again, lifestylesunlimited.com. Go ahead, put it in your browser. When you get there, click on Start Here, and let's get you going.
Thank you for listening to Lifestyles Unlimited's Real Estate Investor Radio Show. Ready for more of the map? Visit lifestylesunlimited.com. Explore our videos and articles. Click on the radio tab to access past show podcasts. View the radio show schedule and listen to our best of radio shows. Want to continue the conversation? Follow Lifestyles Unlimited on Facebook today. We want to meet you as well. Sign up for a free workshop at lifestylesunlimited.com. Until next time, remember, it's not the money, it's the lifestyle.
The information and opinions you hear on the Lifestyles Unlimited Real Estate Investor Radio Show are those of the hosts, guests, and callers and do not necessarily reflect the opinions of this station, its affiliates, its management, or advertisers. The Lifestyles Unlimited Real Estate Investor Radio Show is for entertainment purposes only. Please consult a professional regarding your personal investment needs. Nothing presented on the Lifestyles Unlimited Real Estate Investor Radio Show constitutes an endorsement, recommendation, offer, or solicitation to buy or sell any product or security.